Why trading slowly makes the most possible. There is a major misconception in trading. Most traders believe that if they understand the market faster, make decisions faster, and enter trades earlier, they will catch more opportunities. But in many cases, the reality is exactly the opposite. Some of the biggest advantages in trading come not from being faster, but from knowing when to slow down and wait. Trading slowly does not mean entering every trade late, and it does not mean watching the market for so long that you miss every opportunity. The real meaning of trading slowly is simple. Do not put your money at risk before the market has given you enough information. That is the core idea behind this entire process. You will never avoid every losing trade, and no trader can. But you can avoid many of the trades where you entered based on one large candle, one sudden move, or an emotional reaction. In this video, we are going to look at how slowing down can improve your entries, help you recognize false breakouts, and explain why time itself can become valuable information. Imagine you are watching the Nasdaq. Price approaches a previous resistance level, an area where the market has struggled to move higher before. Then suddenly, a large bullish candle appears. Price breaks above resistance, volume increases, and everything on the chart looks bullish. This is where many traders enter immediately. Their thinking is simple. The breakout happened, the move has started. If I don't enter now, I'm going to miss it. But this is exactly where you need to slow down. The question is not simply, did price break resistance? The better question is, what happened after price broke resistance? That question shifts your focus away from a single event and toward the actual behavior of the market. Suppose the next candle cannot continue higher. Then another candle pushes slightly upward, but closes near its low. Price begins moving back toward the old resistance level. Now the picture is starting to change. What initially looked like a strong bullish breakout is beginning to show weakness. The market is giving you new information. It may be telling you that higher prices are not actually being accepted. And if price eventually closes back below the resistance level, you now have a completely different situation, a potential false breakout. Think about what two different traders did. The first trader bought immediately after seeing the large breakout candle. The second trader waited and wanted to see whether price could actually hold above the breakout level. The first trader reacted to an event. The second trader made a decision based on information. And that small difference can completely change the outcome of a trade. There is an important concept here. A breakout is an event, but acceptance of a new price level is a process. Price moving above resistance for a few seconds or a few minutes does not automatically mean the market has accepted those higher prices. The real question is whether price can stay above that level. After a pullback, do buyers regain control? Does the market continue to hold and trade above the breakout area? Is the market actually accepting the new price level? You cannot answer all of those questions by looking at one breakout candle. You need time. That is why slow trading gives you an advantage. One candle tells you what happened during one period, but several candles can tell you whether the market is accepting or rejecting a price level. For example, imagine Tesla reaching a major resistance zone. The first candle pushes aggressively above the level. The second candle also trades above it, but closes with weakness. Then the third candle moves back inside the previous range. The important information is not simply that price moved above resistance. The important information is that price could not stay above resistance. That distinction can completely change how you view the trade. A fast trader sees the breakout, while a slower trader watches what happens after the breakout. Very often, the reaction after the breakout gives you more useful information than the breakout itself. Now let's look at the opposite situation. Imagine the S&P 500 breaks below a well-established support zone. Several red candles appear, and price is moving sharply lower. A trader sees the breakdown and thinks, support is broken. The market is going lower. Time to short. But then something changes. Price suddenly stops falling. Volume becomes unusually high. Despite the heavy activity, the market cannot continue moving lower, and price begins moving sideways. Why does that matter? because heavy trading activity without continued downside movement may suggest that sellers are meeting significant buying interest. That does not guarantee a reversal, but it does tell you that the initial breakdown deserves more observation. A slower trader does not automatically say, "Support broke, so I should short." Instead, the trader asks, "Can the market actually sustain prices below support?" That is the difference. Breaking a level is one thing, but staying below or above that level is something completely different. To understand the difference, you need to give the market some time. This brings us to one of the most important principles in trading. Time is not always just waiting. Sometimes, time itself is information. Imagine price breaks above an important resistance level. If it immediately falls back below that level a few minutes later, that tells you something. But if price remains above the level, holds during pullbacks, and continues higher, that gives you completely different information. The same is true when price breaks below support. Breaking below the level and actually staying below it are two different things. So when you wait before entering a trade, you are not simply being late. You are giving the market an opportunity to reveal more information. You are allowing price action to tell you whether the move has real acceptance behind it. That is why you do not need to trade every sudden move immediately. Sometimes, the market needs to prove its direction first. Now let's talk about one of the biggest problems in trading: emotional entries. When traders see a large candle forming, fear often takes over. They start thinking, "If I don't enter right now, I'm going to miss the entire move." That is FOMO, and FOMO creates urgency. Urgency creates poor decisions. Imagine the Dow Jones suddenly rallies 200 points. A trader who is patiently waiting for a pullback may suddenly feel pressure to enter. They forget their original plan and think, "There is no time to wait. The market is running." So they enter immediately. But this is often where risk increases because the trade was not based on the original plan. It was based on emotion. Remember, the market does not disappear because you missed one candle. Missing one good setup does not mean you now need to chase price at any cost. Markets continue creating new opportunities. New pullbacks appear, new setups develop, and new confirmation can arrive. Your goal is not to catch every move. Your goal is to participate when you have enough information and a clear reason for entering. There is an important difference between reacting and responding. The trader who enters simply because price is moving fast is reacting to the market. The trader who first studies the level, watches the reaction, waits for confirmation, and then makes a decision is responding to information. A reaction is usually immediate, while a response is deliberate. In trading, that difference matters. You do not have to answer every movement with a trade. Sometimes the best decision is to do nothing. Waiting until the market provides enough information is also part of the trading process. This principle becomes even more important around major economic events such as CPI reports, employment data, Federal Reserve announcements, and major earnings releases. During these events, price can move violently in both directions within seconds. Price may spike sharply higher, then reverse aggressively lower, and only later establish its actual direction. If you enter during the first emotional reaction, you may not be trading market structure at all. You may simply be trading volatility, and volatility can be extremely misleading. A slower approach does not mean ignoring major economic events. It means recognizing that the first reaction may not be reliable. Allow the market to settle. Then identify the important levels and watch how price behaves around them. Does price hold above those levels? Does it get rejected immediately? Is the market moving sideways and showing uncertainty? Once you have more information, you can make a more informed decision. This entire process can be simplified into a simple framework: level to reaction to confirmation to entry. First, identify an important price level. That could be support, resistance, a previous high, or a previous low. Then watch how price reacts around that level. Does price break through it? Does the market reject it? After a breakout, can price actually hold above the level? then wait for confirmation. Only after that should you make an entry decision. Compare that with an emotional trading process. Movement to emotion to entry. Price moves quickly. You feel like you are going to miss the opportunity. You react emotionally, and you enter immediately. That is the pattern slow trading is designed to reduce. Trading slowly does not mean missing every opportunity. It means stopping yourself from chasing every opportunity. Your job is not to catch every point the market moves. Your job is not to trade every breakout or every breakdown. Your job is to recognize situations where the market has not yet provided enough evidence and avoid trading those situations. Sometimes one additional candle can change everything. Sometimes a few more minutes can reveal important information. Sometimes the reaction after a breakout tells you far more than the breakout itself. Remember, a breakout is an event, but acceptance is a process. Time gives you the opportunity to see that process clearly. So the next time the market is moving aggressively, ask yourself, do I actually have enough information to enter this trade? If the answer is no, waiting is not weakness. Waiting is a trading decision. You are not trying to catch every move. You are trying to eliminate the trades where the market has not yet provided enough evidence. And that is the real idea behind trading slowly. In the final part, we will turn this concept into a practical trading process and look at how a trader can use slower execution to improve entries, manage false breakouts, and avoid chasing extended moves.